I think we're going to go ahead and start the webinar now. Thank you for joining us. And the topic of today's webinar is rates and stocks, what's next for markets. And John Calverley, Tricio's chief economist, is going to be kicking things off. Thank you, John. Away you go.
Okay, thanks, Gerry, and hello, everybody. So what I'm going to talk about today, here's the outline. I'm going to start off by looking at the economics. So is the economic growth optimism that we see out there realistic? There is quite a lot of optimism at the moment. Is that actually realistic? Then we're going to look at inflation. Then I want to look at the role of interest rates and liquidity in the way the markets are behaving. And then Gerry, our chief strategist, is going to look at the charts and tell us what they're telling us. But let's dive in straight away and look at GDP. So this is GDP since the fourth quarter of 2019. So obviously the COVID dip, the recovery, and then the 3 years since then. What really stands out here, of course, is the outperformance of the US, the red line there. 8%, 8.5% up over 4 years. That's probably even stronger than you would have expected if you'd made forecasts back in at the end of 2019. Europe and the UK well behind. Now, I would argue, I haven't really got the time to argue it in depth here, but I would argue that the numbers for Europe and the UK are probably a little bit understated because I don't think that Europe or the UK take sufficient account of technology in the way they calculate GDP. So probably they're not quite as far behind the US as this suggests, but they're still behind, and the UK in particular. Now, there's a number of drivers for that. I mean, one is the very strong spending in the US coming out of the US government, very strong fiscal spending. Another is the very strong US consumer. But also the US has shown this strong productivity growth, which we haven't seen in Europe because all three areas have low unemployment. So what about going forward? So the first block here for each area is 2023. So Eurozone and the UK, very, very weak. UK actually in recession in 2023. US very strong, over 3% in 2023. This, by the way, is Q4 to Q4, which I think is a better way of looking at things. But then if you look at the forecasts for 2024 and 2025, all pretty solid. So Eurozone recovering and growing at over 1.5% in 2025. Japan solid at about 1%. Doesn't sound much, but remember the labor force is declining. So in per capita terms, that's pretty good. And the UK here, a bit over 1%, not great, but definitely better. And the US showing here a little bit under 2%, which is about where we think that US growth is, the trend rate of growth. Now, these are OECD forecasts from May. I would say most forecasts are actually a little bit more optimistic than this, a few tenths higher. We saw the Fed yesterday talking about 2% for 2024-25, around 2%. So, and the UK also expected to be a little bit better than this. Now, these are good forecasts because there's growth, but also because you've got a movement back towards trend rates. So the US slowing down a bit, which is a good thing, most people think, and Europe picking up a bit. So quite benign forecasts. Let's look in more detail at the US. So this is the Purchasing Managers Indexes from the ISM, Institute of Supply Management in the US. The green line is the services one. You can see it's really been bouncing around somewhat above 50. 50 is the break even for these. So bouncing around the most recent figure up. I would look to focus really though on the manufacturing, which you can see bottomed about a year ago and has been gradually climbing. We're still waiting for it to go above 50 to start to see manufacturing out of recession. If you look back historically here, you'll see it seems to move in a sort of 3 to 4 year cycle. And that's been the pattern actually long before 2010. So if you go back 30, 40 years, there's a 3 or 4 year cycle in manufacturing. So it would be very surprising if manufacturing does not continue to pick up, as we've already seen from the low, and start to add to growth again going forward. Another area where I think we can see things holding up pretty well is in profits. This is the corporate profits after tax as a percent of GDP. They were very high at periods just after COVID. That was exceptional distortions in the economy, and they're still doing pretty well. Now, when you see profits like this, It means that the corporate sector is basically pretty healthy, means they're unlikely to be cutting jobs, cutting investment. In fact, it's the reverse. What we're seeing at the moment is quite strong investment in the US. So that's all good. So this suggests there's a pretty good outlook for the US. One area where people are a little bit concerned is what's happening to savings. Now, this chart just shows the savings rate. So it's the amount of savings out of income. You can see it's come down recently. Now, that means, of course, that people are spending more than their incomes, and that helps to keep consumer spending going. Some people worry that this will turn up from here. Now, people had accumulated savings just sitting in the bank coming out of COVID. All that money that the US government gave to them during the pandemic, and the fact that they couldn't spend because they couldn't go out, people had accumulated savings. And of course, if you've got accumulated savings, you're going to spend a bit more. So that's going to show up in a low savings rate. So is it going to go up from here? If it did, that would mean a significantly slower economy. But look at where the consumer is. You've got low unemployment. You've got house prices strong. They've come up a lot. A little bit wavering at the moment under the pressure of high interest rates, but basically still very strong. You've got stock prices high, reaching new records. You've got inflation down, which is going to make people more confident. Okay, so maybe you've got some political concerns. Maybe we can talk more about that later. But overall, I think there's no particular reason why the savings rate should go up significantly from here. So that also is a good thing. So if business is confident because profits are high, they're investing, and if consumers are reasonably comfortable, then you wouldn't necessarily expect to see consumer spending fall. And in that environment, that keeps the US economy moving. So to answer my first question, is economic growth optimism realistic? I think yes, broadly. There's no reason to expect a major US slowdown. As I said, we've got consumers in good shape, we've got profits solid, corporates are optimistic, and by the way, much more optimistic than a year ago when many people were expecting recession or at least a big slowdown. And then on the government spending side, I haven't mentioned this so far, but there's an election this year, in case you haven't noticed, and spending is usually pretty high during an election year. It may ease off next year, depending, but we'll have to see on that. And then if you look at Europe, this acceleration that's being forecast, well, the energy shock from the Ukraine war, that's past us now. We're in a situation where wages are growing faster than prices. Of course, that the high wage growth is a worry on the inflation front, but on the growth front, that gives you demand. And then we're already seeing expectations for lower interest rates. ECB has already cut once. Expectations are for the UK to begin cutting later this year. That's already to some extent reflected in bond yields, and that will help with growth in Europe. So, as I say, I think that the optimism on growth for the mild slowdown, only mild slowdown in the US and pickup in Europe is broadly realistic. What about inflation? This is the picture for core CPI for UK, US, and Eurozone. The dark black line at 2%. So obviously we're still above target. We had some good numbers out of the US yesterday, just 0.2% month on month. But basically, core inflation is still too high. And that's why all the central banks are still talking a cautious game. They're sort of saying, well, we're in a restrictive zone. We may be able to reduce the amount of restrictiveness going forward, but we're not in a big hurry. And of course, they're not in a big hurry, partly because the growth outlook is reasonable. I think that would be particularly the case in the UK and the Eurozone, where growth at the end of last year looked very weak. It's picking up now. So I think that adds to their cautious attitude. And in the US too, growth is sticking pretty strong still. So again, Chair Powell yesterday in the press conference, reluctant to move quickly, reluctant to talk about big rate cuts going forward. Let's home in a little bit more on the US. I mentioned that good monthly number there. That's that green bar right at the right-hand side at 0.2%, actually slightly under 0.2. You can see the blue line coming down and most recently coming down a bit faster. One thing I would just point out here is if you look about a year back from where we are on the monthly numbers, you see two very low green bars. So that was June and July last year. Now, they were low. What that means is that as we get the June numbers in a month's time and then the July numbers in a couple of months' time, it's going to be difficult for the year-on-year rate to come down. You'd have to have a very low monthly number in June 2024 and in July 2024 for the actual year-on-year to come down. So we're probably going to have a couple of months where core inflation is where it is, or perhaps even higher, goes up. And then it's going to get better. So later in the year, we're going to see more of a decline, I think, because those monthly numbers from sort of the summer and autumn of 2023 were higher. A lot's going to depend on wage growth. That's been the continued message from the central banks. If anything, they underplay that message because they don't want to imply that it's all workers' fault that we're having inflation. So the way that central banks are thinking is very much that wages is the key. This is the one that, or the data that the US Fed looks at most closely. It's the Atlanta Fed Wage Tracker, which uses the census numbers looking at actual individuals and how their wages change from one year to the next. And you can see it's been coming down nicely. It went nearly 7% year on year. It's come down to 4.7%. But if you look at where we were pre-COVID, it was about 3.5 to 4. That's where they need it to be. So it's come down more than 2 percentage points. It needs to come down 1 more percentage point. And this is what they're waiting for, I think, to see this continue to decline. So will inflation come down as planned? I'm not going to give you quite such an emphatic yes here as I am on the growth outlook. So the answer is probably, most likely, but there are some risks. If we sort of looked at all the data, there's lots of different data series we can look at. I would characterize US inflation, core inflation, as being around about 3% in the US, 3 to 3.5% in the UK, a bit lower in the Eurozone. So this is still a little bit too high. And wage growth is slowing, I've said, but still too high. The risk here is that inflation gets stuck at around the 3% level. And while that may not sound too bad, a lot of people are going to say, well, we can live with that. Actually, the central banks will not be happy with that. So how will they react? Well, I think the first thing they'll do is just keep rates high. They're going to wait. They're going to wait and hope that it's just taking a little longer, which could well be true. It does take time for these things to come down. They'll be looking at the labor market in particular. In the US, we have seen the unemployment rate rise now by about 0.6, which is actually quite a lot. So they're going to be watching that. There is, though, I think, some risk of a rate hike out there. I think we went back 6-9 months, there was no chance of that, it seemed. Now I would say that there is a chance. I think it wouldn't come until next year if it does come. It would come if we don't even see that economic growth slow down, if growth still continues in the US at well over 2%, that would be a concern. If unemployment starts to fall again, that would be a concern, alongside this 3% inflation. So I think the Fed would play a pretty long game on this, although they would start to sound more hawkish. And of course, potentially in that scenario, bond yields would rise in anticipation that A, rates would stay where they are, but B, they might even rise. One thing I would flag is that there's a danger of a conflict here between the central bank, and especially if President Trump is re-elected. He is a low interest rate man. He would be unhappy to see rates stay high, and especially to rise. So this potentially could be quite serious, and I would worry a bit about that. So now what about liquidity? I mentioned I wanted to talk about liquidity, and there's different ways of looking at that. This is just one. I want to focus on US money growth. You can see it rising steadily until 2020. Then that big increase, and that, of course, was behind, or at least connected to the big rise in inflation. Then money growth actually fell. People who watch money a lot started to talk about recession. But you can see it's leveled out, and actually money is starting to grow again. And if you just look at the long-term trend there, we're back on the trend, or even a little bit above trend still for where money is at the moment. And if you look at the velocity of money, which is simply dividing that money number into by GDP, you can see at the end there, that big big drop in velocity. Suddenly there's a lot of money in the economy. GDP is actually falling as well. So you get a big drop, come back up again, but again, it's pretty much on trend. So I think that what liquidity is telling us is there's still plenty of liquidity in the US economy, despite the fact that money has actually fallen from its peak. Just briefly, I want to talk about Japan. I haven't said much about it because it's in a very different place. It's trying to get inflation up, whereas the West is trying to get inflation down. So this chart shows wages, and this is the level of wages, not the growth rate. So you can see how wages were actually falling for a long time, from the late 90s until about 2014, 2015. Fell about 15% in absolute terms. So obviously, if you've got wages falling, you're not going to get inflation of 2%, which has long been their target. If you look at the end there, you can see that wage growth has actually been increasing. There's still a debate about whether it's increasing enough, but in terms of getting that 2% inflation target, which they're aiming at, they're getting a lot closer. And that's why they have started to raise interest rates. That's why the bond yield has risen. So we're quite positive about Japan. You might say, well, hang on a minute, rising rates when they've got such a big debt, is that a good thing? But look at where real interest rates are. Even though they've started to raise short-term rates above zero, and even though bond yields are around 1%, if you get inflation of 2%, you've got a negative real yield there. So that's actually better than having 0% interest rates, 0% bond yields, and inflation at minus 1%. So in terms of the burden on the Japanese government, they're in a better place to have interest rates higher with inflation at 2%. So generally a good outlook. And Gerry in a moment will talk about the Japanese stock market. So what are the risks here to my economic outlook? Well, I think probably growth too strong in the US may now be the greatest risk, more than recession. And that's definitely changed. A year or two ago, we did worry about a big slowdown. Right now, we're thinking actually they may not slow down enough. It may be more than 2% growth again going forward. And linked to that, if inflation sticks at 3%, that is a concern, because then the central banks have to figure out what are they going to do next? Are they actually going to raise rates? Are they going to lean against this? What are they going to do? As I say, I think that would play out over an extended period, like 1 to 2 to 3 years, that kind of time scale. It's not something they're going to be worrying about in September, I don't think, but is potentially the risk out there. I haven't said anything about the Chinese economy. It's a big issue. We can talk more about it in questions if you want. Broadly, our view on China is that they have a lot of structural problems, too much debt, overinvestment, obviously the property collapse. The government has too much debt, so it can't spend its way out of slow growth. A lot of financial issues, but most of the financial sector is either owned or controlled by the government. And that's why we think that all this adds up to slow growth rather than some kind of financial crisis. But nevertheless, there is some risk around that. And then there's the usual geopolitical risks, China, the US, potential issues around trade, but also particularly if President Trump becomes president, but also around the Philippine Sea, around Taiwan, etc. Middle East, Gaza war is still going on. Russia, Ukraine, North Korea. So you've got those. And we've got election risks as well. I don't see the UK as a particular risk, given that the Labour Party is really doing everything it can to come across as very centrist. The French election has caught everybody by surprise, could have some impact. And then I think the US is probably the biggest, the thing that's going to be the biggest talking point going forward. And obviously that is now fast approaching. We can talk about that more if you want in the questions. And a couple of final points on valuations before I turn over to Gerry. So this is the cyclically adjusted price earnings ratio. So it's taking 10 years of earnings adjusted for inflation and comparing with the price of the index. So there's the US. You can see it's come up recently, and it's at a pretty high level. Not as high as it was in the late 90s, which was definitely a bubble. Not as high as it was in 2021, which, remember, interest rates were very low there, so that perhaps made more sense. but pretty high. So this is an issue. Gerry will talk more about this. This has no real bearing on where stocks might go over the next year. There's virtually no relationship between price earnings ratios and what happens to the market over the following year or two. Arguably, it could have some impact if you're thinking 5 to 10 years, but then you do have to take a view on technology in the US and the technology stock companies because they are very much leading this index. If you look at the green line, the Eurozone, and the blue line, the UK, they've ticked up, but they're still at much more moderate levels. And finally, if we look at the Japan's ratio, obviously the Japan stock market, at least in yen, has done very well and breaking out of past ranges. The cyclically adjusted price earnings ratio is up, but it's not particularly high. Nothing like the bubble period in 1990. The ratio was very high again in the early 2000s, largely because earnings were so low at that time over a long period. But right now we're up, but we're still at quite reasonable levels. And with that, I'm going to turn over to our chief strategist, Gerry Celaya.
Thank you, John. Thank you, everybody. Just to let you know how we do things at Tricio is John sets up the economic background in terms of the long-term view using the solver model that we talk about in our quarterly economics for investment articles. And James and I argue with John about, what things are going to do. James has a huge knowledge of what institutional clients are doing, retail clients are doing, and how to use those factors to come up with ideas for investors and portfolio asset allocation and things. My specialty is looking at charts, trying to end up with economic fundamentals, behavioral finance, if you want to give it a fancy title, and trying to come up with different scenarios that John can either say, well, that looks likely, or that doesn't look so likely, or we can have a really good argument about what's going to happen or not happen. So when I look at the charts, I try to give you, this is our core view that ties in with what John's talking about. And if it differs, I'll say so. This is where things might, go different than what we think. And more importantly, I always say, is I'll give you ideas of where I'm going to be wrong. And I can give you levels where, our core view is probably going to be wrong because the market shifted. And to me, that's an important part of any talk or any article that I write is where are we going to be wrong? So having said that, let's fly through the charts here. And if you do have questions, please put them in the chat function. I think John can see them as well. And it's going to be one of those things where we'll talk about the hopefully the answers to the questions at the end of the webinar in a few minutes. All right, the first chart I have is rate cut expectations. And you can see the implied money market curve for dollar futures, sterling futures, and euro futures. Now, the ECB cut rates, and the market didn't shift a heck of a lot because they were looking for the June cut. It was well signaled. And it's one of those things where the market continues to look for further rate cuts down the road. But as John says, they've been tempered. You can see where we were 3 months ago, where everybody was, that's a light blue line on the far right chart, where everybody was looking for more aggressive rate cuts, and that's definitely been taken off the table. Similar things have happened in the UK, or the sterling curve and the dollar curve as well, where 3 months ago people were looking for more aggressive rate cuts, and now they've really scaled that back. So they're pretty much in line with John, what he's been saying for a long time now, which is rates are going to stay higher for longer than people anticipated. Now, here's where I earn my money, if you will. I try to come up with what if the market's wrong? In other words, my bias is that I think we could see the far end of the curve, looking out a year, 2 years, 2.5 years, we could see that maybe shift lower if inflation starts to come back to target levels a little bit faster than people anticipate. And I think the futures curve, the futures traders, money market traders will be pretty happy to see that, and they'll price it accordingly. But that, like John said, that really relies on a lot of things falling in place for the central banks. Next slide, please, John. Now, this slide, I'm going to go through bond markets first, and I'll talk about equity markets, and I'll be talking mostly about the major bond markets. This is a US 10-year note, and it's a monthly chart, and the red line at the bottom is a spread with a 2-year note, with a coupon curve or yield curve, if you will. And the key thing here is that, yes, yields rose since 2020, and yes, 2022 was a horrible year for bond market funds and bond market allocations, but we're not really at nosebleed levels as far as yields are concerned. Yes, real yields are positive now, which is great, but it's one of those things where you look at this and go, wow, yields used to be a lot higher and the economy didn't tank. Different economy, different time, different deadloads. We all know that. However, when we got to 5%, there were serious buyers. So we can see, yes, there is some risk that we go up to 6%, but we don't really see it happening yet. Next slide, please, John. And this is a close-up view. Same yield, same chart, 10 US 10-year. And you can see where we touched 5% and we immediately came down. That's when everybody and his granny was talking about 6 rate cuts in 2024, which the Fed pushed against, and we were saying we don't think it's going to happen. In charting terms, this is a potential keyword. There's potential head and shoulders top, where you see the first shoulder happened in 2022, 2023. Then you had the peak at 5% last year, and now we're forming the last shoulder. Doesn't really matter. But if we start pressing below, let's say 4%, then in our view, that'll help confirm the idea that we're going to go to 380, 330, maybe 3% as the next swing lower. What does this mean for asset allocations? That means that we still like our overweight view on US Treasuries and US tips, because we think that yields will either stay around where they are now, not go significantly higher. And we're wrong if it breaks above 5% on a sustained basis. That's a pretty clear red line for us. And we think that on balance, yields are probably going to come down over the next year, year and a half towards the 3%, maybe even lower levels. Next slide, please, John. Now, what does that mean for the UK market? This is a long-term view of the UK 10-year gilt, and you can see that we hit around 475 and stalled out. Similar pattern. We had a spike higher, consolidation. You hit the highs last year, 2023, and now you're consolidating a bit just below there. Here, we're going to be wrong if yields start trading above 475, aiming for 5% and higher, and that would not be great for the gilt market in terms of sentiment. It's one of those things where you don't really want to see these big figures get lost, because traders, automatically investors, will think, well, if we lost 5%, we might as well think about 6% next. So it's just one of those things to keep in mind. We think we're actually going to see a pullback in gilt yields towards 3% as well. Next slide, please, John. Now, this is a German 10-year Bund, and it's not something we look at all the time in our weeklies or monthlies or even our FEs, but it's something we keep an eye on anyway, because it's a significant market allocation for a lot of investors. And it's one of those things that if you get this wrong, then you're going to get the rest of Europe wrong as well, mostly in terms of direction and spreads. So it's important to watch. And it's one of those things where, again, similar pattern. You saw the break higher after COVID. You saw the move towards significant levels. We don't think it's going to do a lot higher. And the ECB rate cut didn't really shake the market too much. As I said, it was pretty well flagged. And we're looking for a gradual pullback to much lower yield levels, like 2% over the course of the cycle. A lot depends on breaking below the red line, as you can see, to drag yields lower. Now, more importantly, next slide, please, John. This is the Italian 10-year BTP. The reason I said more importantly is those of you who follow John's blogs and his writings, his focuses, will have noticed that he's been writing about debt loads and deficits and things like that lately. And it's one of those things where he's really worried. Correct me if I'm wrong later on, John. He seems really worried that basically governments are spending way too much money and not taking enough in taxation. And it's one of those things where at some stage, I think economists line up and say something's going to give here. Either the market's going to say, look, I can't take any more debt, or they're going to say, fine, we trust you to get the books balanced at some stage, and you can extend and pretend for as long as you like, and we're going to let you have lower yields. But the market's going to have to make a conclusion sooner or later. And Italy is a great one to watch, because you have all the people who are worried about the debt loads and what they're going to be doing here, and you have the ECB saying effectively whatever it takes, with new programs that they launched a couple of years ago to try to protect the spread against the German Bund, which is, by the way, what's on the bottom. Yeah. So when that widened out a couple of years ago, the ECB was relatively quick to say, look, we're going to try to protect sentiment in the Italian bond market. It's one of the biggest markets in Europe in terms of debt. So again, here we're betting that things will go right for the bond market and we'll see lower yields. But so much depends on not making new yield highs above 5%, keeping sentiment basically corralled as far as bears are concerned, and starting to see yields come down, which will probably be dragged down by German yields first, in my view. And it's going to be one of those things where the spread might compress a bit more, but we've seen so much compression lately that there's probably not a heck of a lot to go for in terms of spread compression, which means from a bond perspective that the BTPs are probably the better European bond bet to some extent, because you get a better yield if you're going for euro sort of debt with liquidity. Next slide, please, John. Now, let's look at stocks. And as Tricio's chief strategist, I've had a very easy job since the COVID plunge. And the reason for that is I cut my teeth and made my bread and butter when doing much shorter term tactical stuff and trading and running portfolios. For Tricio, though, we try to take a balanced view for our client base, which is what's going to happen in the next year and a half, 3 years. And for equity markets, it's one of those things where I'd love to get bearish and you say, wow, this is going to tumble forever. But we've been guided higher by the trend since the global financial crisis back over 20 years ago. 20, oh, not quite 20 years ago, 18 years ago ish. And it's one of those things where on this chart, which is a monthly chart, semi-log, that means that the scale is on a logarithmic basis. So you look at percentage differences rather than just arithmetic prices, and it gives you a better reflection of what's really going on. It's tough to get bearish. We're in the middle of a bull channel. And when John and I talk about this with James, it's one of those things where you can look at valuations, like John says, which gives you some indication of, value, if you will, and, whether or not this is a great time to really sell the farm and buy stocks. But it's one of those things in a long-term view, there's not a lot here to get totally bearish on. And we can talk to John about that later in terms of breadth and stuff like that. But for now, we're still relatively happy with the upside. For those of you who follow our asset allocations, you know that we're been neutral on the US market, large caps for a while, and we're pretty happy with that allocation. Next slide, please, John. This is NASDAQ 100, which is a proxy for tech shares in the US to some extent, if you will. And once again, it's a monthly chart, semi-log basis. And you can see here too, we're in the middle of a bull channel. So we can talk about frothy levels, this, that, and the other, making new highs, always a time to worry. But from a charting point of view, we're basically in the middle of a rising long-term channel, and we can get more worried as we go higher, which is something to look forward to, right? And or if we start breaking below the channel support line, which, we're keeping an eye on because that is going to be important for us. Next slide, please, John. Now, this is the Russell 2000. Now, here we had to change our view because we were overweight for some time My apologies for that. We were overweight since October 2023, and we stuck with that for a while. We got the big bounce, which was great, but we didn't do much after that, so we reduced it to neutral in our monthly report. And it's one of those things where we look at it and we go, there's still so much upside here in terms of the trend. Again, semi-log chart, bull channel. It's one of the markets where I think there's a lot of upside potential, but, we need to do so many things to break above the sentiment barrier that seems to be over this index of small cap stocks. Next slide, please, John. Now, I'm not doing the FTSE 100 this time. I'm doing the FTSE 100 Total Return Index, which is a slightly different kettle of fish because it shows the effect of the dividends in the FTSE 100. And the reason I'm doing this is because we argued since, I think, beginning of last year, that the FTSE 100 had a lot of upside potential, and we stuck to that for a while. And we are still sticking with that now. It's one of those things where everybody talks about the lack of momentum in the FTSE and this, that, and the other. But if you look at this chart with dividends put back into it, again, on a semi-log basis, monthly chart, this does not look bearish. This doesn't look that toppy to me. Yes, we're above the rising blue line that was resistance. We're above that now. I would get worried at the red line and the purple line above this. So we've got at least another 10, 15% to go, in my view, before we can start thinking, okay, we're pumping into resistance areas. Next slide, please, John. Now, we don't look at the European shares in our webinars too often, but this is the Stocks 50 as a proxy for European sentiment of large caps. Breaking higher, we're looking at the all-time highs now near 5,500 as the next logical target in our view. Again, semi-log monthly chart. There's not a lot here to say it's going to reverse lower than near term. So it's one of those things that, yeah, we're keeping an eye on because we have broken higher above the rising line, the blue line. But, there's nothing here to say it's got to reverse right now. Let's see what happens when we get to the all-time highs. Next slide, please, John. FTSE MIB. The reason we're looking at this is, again, we're looking at Italian bond yields, and we're saying Italian bond yields could come lower. That's obviously helping sentiment. And it's one of those things that you get the knock-on effect if all things go well. Like John said, that's going to be a lot of things that have to fall in the right place for the central banks. You could actually see upside momentum build further here. We didn't see the election of the new government, draw out investors in terms of making them sell. In fact, they seem quite happy with what they're seeing actually happen in Italy so far. So it's one of those things where we look at this and we look, okay, we could actually see a return to the pre-global financial crisis highs and even back to 2000 highs, which is leaving us a pretty decent upside potential on this chart. So it's one of those things where we're breaking higher, and if we can maintain this break higher, which I think we probably will, then we should see significant gains in Italian shares. And I think the last chart, please, John. Yes. We talked about Japan. John was good enough to mention that it doesn't seem overvalued on his Cape cycle view on terms of valuations, which is great news for everybody who's been worried, like we have, that this market is getting pretty frothy. And the only reason, to be honest, that we're saying it's getting looking pretty frothy is we're back towards the 1989 highs, which, to be fair, over the last 3 decades, we kind of gave up on. We thought we'd never see these again, and yet here we are. Now, we've been lucky, and you can say it's better to be lucky than good because we've been very bullish on topics for some time now, and it's worked out in our favor. So it's fantastic. We know many of our clients have as well, which is great. And the reason I'm looking at the chart here, again, monthly, semi-log basis, is to just show, yes, we've come a long way. Yes, we have a big psychological barrier to breakthrough. That's pretty much at hand. That's the all-time highs. But I think we will see gains above this to the rising line. That should put us around 3,200 or so. So there's some decent upside potential before we actually start getting into resistance lines again. But yeah, we have a barrier coming up now. And we have the Bank of Japan meeting today and tomorrow, John, which, it could actually either be good or bad. And that's just the way we have to play it. So that's it from me, I believe. John, the next slide. Yes, that's us, our smiling faces. Thank you. And if you do have questions, I'm going to open up the chat here just in case something comes through. I know we had 2 questions before, and I have 2 other cheeky questions as well. Now, the first question, and I'm just going to throw this at you straight, John, is if Trump wins again, he's promising serious tariffs. How will that affect U.S. growth, maybe global growth, and maybe stock market sentiment in 2 seconds or less? Now you have time. Go ahead.
Tariffs are always a bad thing. They will hurt the US economy. Tariffs will hurt the US economy. The appeal to Trump is that he wrongly thinks in terms of trade balances and competition between countries to export. But also, of course, tariffs will bring in money to the government. Because you're basically taxing American consumers and companies that need to import raw materials and intermediate and even finished goods. So it's appealing to him for that reason. Europe, I think, would probably respond if he put a general tariff across the board. And China, of course, will respond as well, as it has in the past. So it's generally a bad thing. It will hurt US GDP. It will hurt a lot of US companies that need imports. It's a bad thing because it affects efficiency and productivity. That's why it's bad. So I think that's a negative thing. I should add, actually, it will tend to add to inflation as well, for obvious reasons. And that makes the Fed's job more difficult. So generally, it's all round bad. Whether he will go go that far, we're not sure. I mean, he does tend to threaten things and try to get concessions out of people. On the other hand, there's also this view that second time round he's going to be much stronger in sort of insisting on his ideas rather than suggesting it in a meeting and then his ministers all go around and try to avoid doing what he wants, which is what happened last time to a significant degree. But yeah, I am concerned about that. And Trump does have the edge at the moment for the election. So this is a concern.
That's something to keep in the back pocket of, if you are worried, here's another reason to be worried, sort of thing.
Yeah, I mean, in terms of what a Trump victory would mean for markets, particularly US markets, I mean, there would be some uncertainty as to exactly what he would do. And of course, the US system means we wouldn't know that. He would win in November. We wouldn't really know what he's going to do until January, February, and even and on after that. It would also is going to depend enormously on how Congress goes. Both the Senate and the House are very close at the moment. Could go either way. So that's going to matter. Business is going to say, okay, well, we did okay last time Trump was president. The stock market did very well. The economy did very well. And of course, he cut taxes. So business is not going to be overly concerned in general. Individual companies might be concerned. If you're in the green sort of sectors, you might have some concern. Although again, I suspect that a lot of the spending on green initiatives would still go ahead even under Trump.
Right. That makes a lot of sense. Thanks, John. The next question is on productivity. And, we saw the charts of the NASDAQ and S&P, and it's one of those things where people are clearly backing AI and stuff. And you were talking about this back in 2021 and stuff, saying that technology is going to be key to productivity gains, and productivity gains are great for stock markets. So your core view on this, with the US economy doing so well, is will productivity goose it even further?
I think this is the biggest single question for the world, for the Western economies over the next 10 years. We've had a pretty lean run everywhere, really since the global financial crisis, or even slightly before, where productivity has been quite poor. You see it particularly in the UK, where it's very poor, and countries like Italy, where it's been very poor. It's been somewhat better in the US, and it's been a little bit better in the US since COVID. But partly, I think, because the economy has been running hot. When you run an economy hot, you tend to drive a bit of productivity growth. But whether AI will add to this and really drive things, along with robotics and so on, some other developments, I'm kind of optimistic, although it's sort of a long run thing. It doesn't necessarily mean it's going to kick in next year. Even today, with everybody very excited about AI, everybody trying AI, finding real killer apps for it is still a question mark for a lot of people. So a lot of people are playing with it, trying it. I think it is going to make a big difference in certain parts of business, but I think that's still all to be played for, and we'll have to see. As I say, I am optimistic, and I think that would be great news because it would support economic growth, help to bring inflation down, and it is good for stock markets, as you say.
Okay, to put it bluntly, everybody's bought into the sizzle at some stage. At some stage, we need to see what the steak looks like, right? And see if there is actually a steak behind all the sizzle.
Yeah, I mean, I don't know. Apple recently announced its Apple Intelligence, so it's going to be using more AI in its phones. Then you look at how you can use that and what the apps are going to be, and you think, well, is that going to make much difference?
Oh,
So
that just annoy you.
this,
Yes.
well, yeah, yeah, yes.
Okay, John. We have a question from one of the webinar attendees, which I think strikes to the heart of what you've been arguing for quite some time now, which is growth looks set to continue, but how much of this is a result of excessive government spending, particularly in the US, UK, and China? Would that change very quickly as spending taps are slowed down? And how long can deficit spending continue? Now, in this one, I'm going to be quite serious and say you got less than 5 minutes. Otherwise, we're going to be here for 2 days.
Yeah, there's lots of big questions there. I
Yes.
mean, you're absolutely right. The US growth over the last couple of years has been particularly supported by government spending. Um, there was COVID, and it made sense to spend money. It made sense to support people and support businesses, but that support carried on far too long, I think, which is one of the reasons why we had the high inflation. But it still carried on. So we had a situation where you had tight monetary policy combined with pretty loose fiscal policy in the US. And that combination gave you pretty strong economic growth. It also gave you the strong dollar, which we've seen. Going forward, as I mentioned, this year, I think the taps are still on in the US, and that's what you'd expect in an election year. Things could change next year, and I'm watching very carefully to see whether the sort of view that actually deficits do matter and debt does matter, whether that view is coming back to the fore. I think Liz Truss did the world a service by sort of pointing in that direction.
That's the nicest thing anybody said about her in a long time.
Well, yeah. I don't know whether the US pays all that much attention to it. And people, of
It
course,
was
point to
mentioned by the
Japan.
Treasury, Yellen and the Fed. So yeah.
Yeah. I mean, people also always point to Japan and say, look, they have this huge debt and they manage it. But as I mentioned, of course, they've had negative real interest rates for a long time. In the US has positive real interest rates now, with inflation back down to around 3% and interest rates at 5%. So it's actually more expensive. And governments are seeing that. We are seeing that in government accounts, that they're now paying a lot of debt interest, and that makes life more difficult. So I think that they probably will get a bit more serious about bringing deficits down. In the US cycle, you tend to see that the year after elections. So next year is a potential year for actually reducing deficits, and then after the midterms, that year, to 2 years further on, 2027, that will be another year where we might see some cutbacks. US has a deficit running around 6% of GDP, so it's very high. We would have thought, given that we've got more or less full employment, strong economy, you would have thought that they would have it well under 3%. Instead, it's 6%. So this is an issue. And it's also an issue in Europe and in the UK, and of course in Japan, where deficits remain high. So I do have some concerns about that. One positive thing, just thinking about the big picture, is if you do see actual reductions in deficits, remember there's room to cut interest rates from where we are now.
It's true.
So that was one of the problems back in 2010, 2011. You know, the UK had its austerity program, and that was great. But if you have an austerity program when interest rates are already at rock bottom, there's no room to have a compensating expansionary monetary policy alongside your tight fiscal policy. So that was one of the reasons why UK growth was quite slow in that period. There just wasn't room. Quantitative easing was done, and that helped a bit, but that wasn't enough. So I think tighter fiscal policy would lead to more easy monetary policy, which, by the way, would be very good news for markets. That's an ideal combination for markets. So if we go that route, that would be good. If we don't go that route, then yeah, I think you're going to see the term premium for long-term yields relatively higher than it has been. We're probably already there, actually. So that's saying that people do get more concerned about long-term holding long-term bonds, because ultimately they see high deficits and high debt as potentially inflationary. So that, I think, is a real concern. You mentioned also China.
Yes.
I have a lot of concerns around China, because a lot of people think that the Chinese government is crazy because it isn't doing more fiscal stimulus, given the weakness in growth. I think people are misunderstanding the fiscal position in China. I think they have a really serious problem with a big deficit and high debt. The IMF regularly publishes data on an adjusted deficit, and it's huge. And the debt is very high as well, government debt. So I think China actually has a real fiscal problem, which I think a lot of people overlook. So how the fiscal picture works out going forward is going to depend quite a bit on where real interest rates are. We've had 10 years leading up to a couple of years ago where real interest rates were pretty low, but they may well be higher going forward. So this is going to be a real concern.
Thank you, John. And just because in the UK we have the election coming up pretty soon, and it seems like everybody has a magic money tree. Well, it's like the planting forest of magic money trees, if you will, in the UK. How do you think that's going to pan out?
Well, I mean, I guess most people are pretty sure that Labour will win. It certainly looks that way. Quite how big a majority they get is unclear. But assuming they win, they are trying to present a fairly cautious approach. So their manifesto came up with some tax increases in specific areas. I mean, there's still a bit of smoke and mirrors because they're talking about dealing with tax avoidance and so on, which may be illusory. I think they're being unrealistic about what they'll need to do on the spending side, because we know that many parts of the government are going to be squeezed the way the numbers are set up at the moment. We also know that public sector pay is likely to have to rise. It probably would have had to rise anyway, but Labour governments always raise public sector salaries. So it's going to be really tight for them, I think. But unless they are really just, essentially lying about what they're going to do, then they will have to stick with a fairly tight situation. What I would say is that, some people say, well, they're inheriting a really bad economy. Well, actually, I would say, no, they're not really. We've had a really bad economy because of COVID, because of Ukraine, perhaps because of some other reasons as well. But actually, cyclically, it's picking up quite nicely, and it could easily grow a bit faster than people are expecting. Now, whether productivity is going to really kick in and give us much stronger growth, that remains to be seen. But the numbers actually could look a little bit better than people are currently expecting for the budget next year. So I'm not too pessimistic about the UK budget situation. I think they've got some tough decisions to make. I think a lot of people are going to be disappointed that they're just not going to be able to spend a whole lot of money, and they're not going to be able to turn around the NHS and do things like that in a hurry. But I don't think it's actually as bad as some people suggest.
All right, John. And just to finish off, I guess I asked you before, and you're going to reiterate, what's the chance of the Bank of England cutting rates next week, John?
I would say almost zero chance. I mean, if there wasn't an election, then it would certainly be in play, I would say. The ECB has cut, but the Fed hasn't. I think the UK inflation picture, if you remember the chart I showed, UK inflation peaked about a year after the US. It's kind of somewhat behind the US, and it's still higher than in the US and Europe. And wage growth is, I would say, a particular concern in the UK. We've just had the minimum wage increase, which will tend to push up wages. I think the Bank of England probably wouldn't have cut anyway. And with an election, I think they'll be much more inclined to say, well, let's just sit this one out. I think the real question is, will they cut in the next meeting? And obviously it's data dependent, we'll have to see. I think they're going to be a bit like the Fed. I think they're going to be pretty cautious in cutting, and they may well wait for some considerable time longer.
But I guess my view is that they'll probably lean heavily towards saying, yes, the next move is more than likely to be a cut. It's just a matter of when, not if.
I think that's right. I mean, and of course, that's the kind of the way they operate, sort of pointing to what the market's saying, and then giving their forecast for where inflation's going and so on. That'll be kind of implied, yes.
Good. All right. Well, thank you, everybody. And if you have any follow-up questions later on that you didn't get to ask this time around, please send us an email, and we're more than happy to respond. And we'll send you the link of the recording once it's up on our YouTube channel. And just to let you know, all our previous webinars, we usually keep them out for 6 months or so. They're all up on the YouTube channel now. So if you want to see, I don't know why, but if you want to see what we were saying back in 2020, 2021, 2022, and 2023, you're more than welcome to go look at our YouTube channel, Tricio Advisors, and you should find us. And you can subscribe to the YouTube channel so you get notified when we put something up in there. But again, thank you for everybody for joining us. Thank you, John. Thank you, James. And we'll see you next time.